What's up, everyone? Welcome back to the Outlier podcast. I have Kris from Moontower AI, the dude that has everything perfectly sorted out, knows what's going to happen, predicts the future. So everybody's going to walk out of this like super rich and it's going to be easy. So thank you for committing to that promise and guaranteeing that, Kris. It's great to have you.
Eric, it's awesome to be here, man. It's really nice to meet you like this and get to hang out for a little bit.
Beautiful. Well, the first thing I want to pick your brain a little bit on is I don't want to waste your time, go through your background. You have a lot of that on other podcasts, so people can easily pick that stuff up. But there's a couple pieces about your background that I'm most interested in, which is the first one is what precipitated the pivot from SIG? And you've talked about this loosely, but there's a couple pieces I want to double click into.
Yeah, that one. Yeah, and I actually haven't talked about that like super closely before. But so what happened was, this was uh, so 2000 in 2007. Uh, I was in the I was in the heating oil and gasoline options pit on the NYMEX at the time, and I was having a really good had a really good year, and uh, my there was a I made friends with like a couple guys in the pit. One of them in particular became a very good friend of mine. And he was this character that he like never held a job. Like he was just too feral, I think, to like work for people. So he was a really smart dude. But he came out of college, somehow landed on the floor, started trading like silver when he was like 21 or 22 years old on on the floor. And then he found his way to the heating oil options pit. He kind of like we just vibed. He just saw things in like a really he was not like a regular market maker. He was like a position trader. Like he had a like he'd be like this doesn't make sense. Like this relationship doesn't make sense, and he would like put it on and not and so in other words, like he was kind of trading the way I was trading, but he was doing it differently because I was with SIG. And so it's a lot easier to take risk when you work for a company, especially a company that's super well capitalized. But this guy was pretty much trading his own money, and he was trading pretty large in that kind of position trading way. And I just generally found him inspiring. Like the more I talked to him, it was more like he was a very philosophical cat. Like he was a big reader, and he's probably one of the most read people I've ever met. He had traveled the world. He would take 6 months off every year, just backpack, like, and he just kind of convinced me. It was kind of him, really. Like he convinced me. He was like, dude, you're making. He kind of had a sense of how much money I was making, and he was like, dude, if you just come and get backed, you could get uh you can get like a 70% deal where you're gonna get 70% of your P&L. And yeah, you're not gonna be able to trade as big, but like you know what you're doing. You're doing pretty much the same kind of stuff I'm doing. So you're just gonna walk away with a lot more if you come do it over here. So he went to his bosses and he or like his backers because he had like a lot of money up with his firm, but like he still had a boss because somebody still owns the ultimate risk. He's getting that's why you're giving up 30%, somebody to hold the ultimate bag. So he went to them and said, I want to back this guy in my pit. I think we should bring him on. And that was kind of it. It was just kind of like animal spirits. I can go on my own and get a larger cut of the pie. And that was like pretty much how I left. There was no like I left on good terms with SIG. I was good with my bosses were good with me. They you understand. It's like they understand. It's not like if somebody wants to go see what they can do on their own, you're not gonna convince them otherwise.
Right. How long were you at SIG for in total?
Almost 8 years.
So, if you were to give somebody a crash course on SIG in 8 years, the most impactful lessons you've taken away from there, what would that look like?
Massive respect for the market. Like
Mm.
sig traders like really have a lot of respect for what bids and offers are saying. So it's a lot of just a lot of belief in that you might have some prior and you have to update based upon how the market's kind of reacting to you. And a a lot of the job of trading is you're not going to have all the information. So you need to be pretty well calibrated about how much you do know and how much sort of how much you can bet and how much conviction you can have based on your knowledge of how much you know. And you have to be really humble about that. And that's like it's a tricky thing because if you're too humble, the problem is like if you're too humble, you will not have the fortitude to act when you should be acting. And if you're not humble enough, well, that's the easy case of being like you're obviously going to blow up. So, um, that's the two failure modes and kind of finding your way in the middle. And I think Sig just does like a really good job of um, sort of teaching you what risk is and teaching you that this is uh, teaching you like this thing that looks risky, why it might not be risky, or this thing that looks like it's benign actually is pretty risky. So it's a I think that it's and ultimately that this is the job. I mean, you're putting a price on liquidity. Like you're putting, somebody's coming in to buy these things. It's like, well, how much can they push it up? How much could they have to buy? Like these kinds of questions kind of calibrate for you, what is the right price for this liquidity? And I think going through those exercises a lot basically gets you, it just gives you like the right appreciation for risk, which at the end of the day is the game. Like we don't, I say like a good trader don't have to predict anything. It's like you could, for example, like actually you could be, let's say somebody leaves your firm and they just give you their book and they're like, you manage this book now. Well, it's like they can give you this book and it's got all these positions that you may or may not want. And it's like you just got to manage this book of stuff that you don't want. Like a good trader can just be slotted in and just manage whatever they're given because they've learned how to think about risk. I mean, SIG doesn't think about traders as like you are a bond trader, you are a stock trader. They're just like you are a trader, and the skills that a trader encompasses can just be applied to whatever. Like any market you're in, you have to learn the details of how that market works, um, they but your general trading ability is the thing that sits over all of it. And that was like sure that was I mean they're just not saying that. I mean I started in ETFs and then I was doing index options and then I was doing equity options and then I was did ETFs again and then I was doing futures options. Like they mean it. It's like hey, you want to go do something new, go over there and do that. Try that out. And it's like you go in there and you're like, it's like, hey, we know that you're gonna probably lose money or not know what you're doing for the first few months. Uh, but that's what we would expect. I mean, you never did it before. Why would you be good at it on day one? So, yeah, I think what I learned from SIG is basically like this mix of like humility, but the confidence to be able to learn whatever you needed to learn. So it's like super, it's like this buzzwordy thing, growth mindset, but like it was definitely a growth mindset place. They're like famously a place that thinks that traders are made, not born. So I was very lucky to come up through that environment. Very nurturing.
It's super cool because I spent time as a Marine officer, and as you're talking about a lot of the things that kind of formed you when you were at SIG, it's just I heavily relate to them very differently because for like Marine officers, you are a generalist that has to be able to get really specific about specific things at times, but then you have to be able to zoom back out and learn something else as compared to the super like specialist style jobs, which is a slightly different thing. For me, the time that I spent in the military is directly translated into the way that I do a lot of stuff in trading and markets. I have to assume that that has to be the case. We were literally just talking about your tool that you're built and continuing to build out, and how that's almost a reflection of that, right? Like you used to view things in a certain way and you want the ability to visualize them that same way. I want to double click into some of the things that you learned during your experiences at SIG, whether it's this risk relationship with risk, understanding of risk, how to price things. What are the main things that you've carried forward into your own trading style? Because there's also a lot of stuff that you might know from there that might not directly carry over.
Yeah, I think one of the I would say like the probably one of the biggest thing, it's the thing that is the guides, even how we build the app, everything. And it's this idea that that this wasn't a SIG thing, but I call it measurement, not prediction. And it's this idea that you need to measure things in a way that's coherent. So, for example, if you take like really, we can take examples actually from just the general investing world. If you have two people and you ask them what their returns were that year, and one person's like, I was up 20%, another person's like, I was up 60%. Well, you can't say anything about like who did better, right? Because there's no beta adjustment to that. There's no risk adjustment to that. There's no like you can't just compare these things. So, but like that's just like a really basic example. But this comes down to like everything. Like when for example, like in our like the dashboard that we look at for what prices are doing today. Well, what we do is like rather than just say what are the percent returns of all these things, that feels that doesn't feel like a lot of information to me. Like I want to know what is the percent return normalizing for the things vol. So we take every move and we divide it by the move that was implied by the options. So a 3% move in SPY is, three standard deviations, and a 3% move in Tesla is Tuesday. So, so like so that's like the one of the most basic things. And then that carries over like you can just keep peeling that back because that just goes right down to uh okay, how do we normalize for vol? And like, I write a lot about like for example, how time works. Like and how to compare one option model's IV versus another options model IV. Like, that just all that stuff gets more and more technical, but it's the principle that underlies everything is how do I compare things coherently? So I think that's probably one of the biggest principles, and because the idea is if you can compare everything coherently, if you think about what trading is, it's like you're trying to find something that doesn't make sense. Like at the end of the day, you're trying to find a contradiction, right? I think when people first get introduced to trading or even investing, they think about it as like my job is to like predict whether the market's going to go up or down or whatever. And it's like, look, man, I don't know if somebody thinks they have edge in SPY, like all power to them. I don't, you're not going to meet a SIG person that thinks that you have any edge in SPY. They don't have any edge in SPY. Like we don't know what's going to happen in the future, right? But what we have to do is uh, look at the world in a way where like, can I find contradictions? And then what I can say is like, well, this thing, if A is here and B is there, the state of the world where these things don't sort of like converge is very unlikely. Or it's the chance of them converging is this, and the market's offering me like this odds on the convergence, right? Like that's probably more likely what it is. So the question is like, what's the chance of these things that are contradicting converging in some way, and what odds are my sort of being offered on that possibility? So that's kind of the whole point is let me normalize everything and see what sticks out. And then I can find the contradictions. Like, hey, that's kind of once everything is on the same scale in a sense. It's like, hey, well, that's weird. Why is that one there and this one here? And normally, again, this comes back to the humility thing. Normally when that happens, it's for a good reason. Like right now, we're kind of talking about this before we turn the camera on here. But, you know, uh, right now, like VRPs are a little high in the market right now. If you look at the implied vols, they're trading kind of fat to where the realized vol is. But it's like it is earnings season. So the market is looking forward not looking backwards when it's pricing that implied vol. That's always true, but there's a known event in front of the car. So the implied vol is weighting itself heavily to the known event that's coming up. So normally, looking at the IV, looking at that relationship, it's going to have less impact of like this thing that we know is coming up. So now, uh, it makes sense that you might look at something and be like, why is that thing high and this thing's low? It's like, well, that thing has earnings in it. So if you normalize for that, maybe it doesn't look so fat anymore. So that's ultimately the job, is to like, when you first start out, you throw it all against the wall and you say like, hey, let me put all this stuff on a scatter plot and see what sticks out. And then you start to look at all the outliers on that scatter plot. You say, oh, that one, what's going on there? And you investigate and you're like, actually, it deserves to be there. It deserves to be there. And and because there's earnings coming up, the reason it's there is because I have not normalized for earnings. And if I do normalize for earnings, it's going to come right back into the blob and it's not going to be interesting anymore. So, ultimately, I think of trading as the job of sort of like sniffing out what doesn't make sense. Or, again, most things when they are sort of off the blob, there's a good reason for it. But there you at least have the possibility of like debating the reason and being like, well, the market is kind of expecting this and that's why it's putting it there. And then maybe you can disagree. You can disagree with that. But you first have to recognize that that's why it's off the blob. You haven't even noticed that it was off the blob. Like if you don't have a way of seeing the world in a relative way, you don't even know that that thing is off the blob. So I think that that pretty much like where all trading starts for me, is like, let me put everything in a similar way of seeing the world and then see what sticks out.
The fascinating thing about that is it straddles an interesting line because you're talking about it directly. This idea that you can find things that are slightly standing out, but we also know markets are generally efficient. We know that strong form is not a thing, but they're generally efficient. I imagine for most retail traders, when they see that anomaly, they're mostly thinking there's got to be a good reason for this. I just don't know what it is. Because what you were talking about before, maybe they're too humble and they think that there's something really smart priced into this and I just don't know it. I just don't see it. How do you develop that intuition in that sense? Because to your broader point earlier, you never fully know, but it
Yeah.
becomes a pot odds play. So, how do you develop that intuition in those instances to be able to see that thing that looks different and say, I think there's something here?
You get kicked in the face. Like no, no so it's like sounds ridiculous, but like that's what happens is you something looks really interesting. You put it on, you find a brand new way to lose. You're like, I got it. I understand now. Like that can happen. And then that pattern becomes part of your library. So I think like one that was really I felt, I was in the middle of the action on this, I felt it, but in late 2020 and late and early 2021, that's when you were getting this business with SoftBank was lifting all those tech calls. They like pushed out the call skew in a big way and all the single stock vol. And, when they did that, the market making community got run over on all that stuff. And it's because all that stuff looked really, really expensive on the kind of metrics that they were looking at. The kind of metrics we look at, it looks expensive. So it's going to get crowded because one thing is like market makers, market makers don't do market maker on market maker crime, generally speaking, like because they all kind of think the same. So I can tell you right now, like if I was quoting something in, some options on whatever, and the broker shows me the market in voice, and it's like, the market's like 5 bid at 10. It's like you got three, the customer's bidding five, and he's gonna let me know, like, by the way, you have three sellers at 510 with you. Well, I could probably name he can't tell me who they are, but I can guess who the three sellers are with a pretty high degree of confidence. So it's because we all think the same. And we all came at like, so we're all using a very similar uh, sort of framework for looking at the world. So because because of that, all the market makers are going to get beat up selling these calls because it'll look fat to everybody. But then you realize like, whoa, this is like a new pattern that somebody could come in and like just power lift all these calls in the size they did as relentlessly as they did. And then the Wall Street bet stuff was also an example that's like, whoa, it turns out this like um people on the internet in these forums really can sort of like aggregate their buying power in that way. And so that there was no that pattern was not as strong for sure before these times that it had happened. So you can so what happens like that thing looks fat, you get worked on it when you go and you sell it, and then you realize and then you learn like after the fact, oh, it turns out they can coordinate pretty good in those message boards. Or this SoftBank dude really does really, there's somebody out there that really will spend this much money on calls and like take this shot and all that stuff. And like I haven't seen that before. So you get beat up on it. And then what happens is it becomes part of your library of like that can happen. And so the more things you get hurt on, the more you build up this memory for how you can get beat up on stuff. And like just from like being a market maker, the whole like world of getting picked off. So you get picked off enough, you start to like know the tricks, or you start to see, how you were set up to get picked off. And then if you start to feel that kind of pattern coming on again, your antenna goes up. So I think that it's just experience. And the difficult thing is like if you have a really, really great idea of why something is pushed out of line and why it would come back in line, you can bet with sort of like you could probably bet with sort of higher conviction. Sometimes it looks really fat, but you're a little sus on the whole thing. And so you might take the other side of it, but like in the back of your mind, be like, I kind of think the other shoe is gonna drop on me. So like, I don't know how I'm gonna lose to this, but there's something I don't know, and I'm probably gonna get worked on it. But I still kind of think I'm getting odds. So it's like over time, you kind of get this instinct for like a fool's bet versus a real opportunity.
How do you adjust for path in that system? Because obviously, every once in a while, you could have this event leads to a loss, but it literally could just be random path, not necessarily something systemic. So, talk more about refining that. Obviously, there's a couple things I can imagine you'll say, but I'm curious how you think about it.
Yeah, so I think about path as far as I think about path in terms of it's a risk management problem. So I think risk management comes down. I think about risk management in two ways. So I think about local risk management and risk management in terms of a shock. Like, you wake up one morning and like the world is different, right? So so your local risk management is stuff like I mean, like it's kind of like what banks would probably call VAR. I don't know the exact definition of VAR, but the way my version of VAR is just, um, hey, if I have $100,000 worth of a stock that has a 5% daily vol, then I want 66% of the time, I think that my P&L is going to be within $5,000, and 95% of the time it's going to be within $10,000. And yeah, there's fat tails, so it won't be quite that clean. But for the most part, but that's the point. It's like for a local move, the whole idea is like for a normal day, those metrics are actually fine. You'll be fine with those metrics. Like you will not be off by sort of an order of magnitude. The thing that you do need to be concerned about though is having a separate risk management system for what happens if I wake up tomorrow and the world is really different, right? Like, uh, correlation in the market, implied correlation goes from 30 to 80, right? Like something insane. So in that case, that's where you would sort of unwant, like you would look at your book, like in the first scenario, we're looking at your book like locally. You can probably like you're relying on your correlations, right? So you might be like, okay, I'm long $100,000 of this, I'm short $100,000 of this. They have like some correlation between them, and from there, I can sort of like do a little math and back out my like daily portfolio vol, whatever. But in the world goes crazy mode, I have to say, okay, correlations between these things. What happens if I shock my book to one and I raise the vols on all my legs? That will have the net effect of pushing a relative value book that looks neutral into all just gross positions, right? Like I was long 100,000, I'm short 100,000, and I think I'm hedged. But once I apply that shock to the book, it just looks like I have $200,000 of exposure. So, uh, so by understanding like what's my nets are handy for day to day, my gross is what I care about when the world goes when there's no assumptions allowed anymore. That then I'm then looking at my gross risk. So in the context of like trading, we would sort of have, what is my daily or weekly standard deviation of P&L that's expected, and then what happens if I wake up tomorrow and oil's down 50%? How much do I lose? And so you would have risk requirements around, you are simply not allowed to have a position that would lose X dollars in oil down 50%. Obviously, there's a pretty liberal like bar there, right? It's like they're gonna, I mean, if you can't lose like what is a pretty healthy chunk of money on oil being down 50%, you pretty much can't trade,
Right.
right? So like the bar is high, but it should not be so but it cannot be so high that it threatens the continuity of your business. That's what you're trading off against. So it's like you're dealing with business. It's like your biggest concern is like business risk, not market risk in a sense, like in the tails. So that's how I largely think about like path is one of these things where like sometimes I win to it and sometimes I lose to it. Like my in the options world, if I sell let's say I buy like a 30 delta call and I hedge it daily, okay? Like and let's say I buy it for 24 vol and we end up realizing 30 vol. You'd be like, wow, great, that's probably going to be a win. Well, not if it expires on the strike, okay? Like if it goes up rapidly to like generate sort of like that 30 vol move from like now until like 2 days before expiration, and then 2 days before expiration it just stops dead on the strike for 3 days, I might get a realized vol that says 30, but that path was just brutal, right? Because I was I was long the call and I was short stock lower, right? Like I'm long, right? And then the stock jumps up towards my strike. All I do is get worked on my short shares. And then right when it's basically a straddle at that point, because it's at the money, the market stops moving. So all I've done is lost money on my shares, plus I've lost all my premium on my calls, and I get destroyed. Right. So, it's like that whole like, oh, you can only lose as much money as like if you buy options. That's true if you don't delta hedge them, but you can lose multiples of your premium buying an option and delta hedging it, right? If it lands on your strike. So but there are times when you win to that too, so you can't just focus on that. So I figure over enough samples, all that evens out, and then you're just left with this problem of managing my daily risk versus my shocks.
Now, when you're running some of these different kind of strategies, especially option strategies, standard deviations of returns can be pretty high. So then if you're trying to figure out, like actually calculate a coefficient variance to then figure out how many samples you need before you have something that's, at a set confidence interval, that can be like an astronomically high number, right? You could have something where you need 15,000 trades or something like that in order to see like how this one system performs with a 95% confidence interval. So obviously you'd be trading a long time, even if it's pretty active in order to hit that. How do you think about developing a confidence interval in a specific strategy or in a specific kind of trade that you're running, understanding that standard deviation and volatility of returns can really blow out the sample size required in order to develop a like confirmed confidence interval.
Yeah, I think that one thing you can kind of do there is, well, first of all, this is like if you're not a systematic trader, meaning that you're not doing like tons of trades a day, this is sort of one of the most, I mean, you're asking me like one of the most diabolical questions that I
I know.
actually think exists, right? So it's hard. I think that there's a lot of a person could literally probably get through a career if they have not done enough trades that goes very well and not have any idea whether they had any edge or not. So this is just a fundamentally very difficult problem when it comes to discretionary trading. So first of all, but I would say I think one of the things that helps is trying to finding a way to sort of like measure something in the middle. The whole question that we have here is what you're really getting at is like, how do I get some feedback before I have to have the 15,000 trades? It's like that's what you're craving. I need some kind of feedback that is sensible. So I just say like, one thing trading firms we did is like sort of have you would do this something like attribution, for example. Like we have a tool that says, you know, if if I look at the things that I bought, did it did I if I platonically measure the result of this trade rather what my result was, which could be like or like say I have like a basket of longs. It's like if I when you buy something, you might hedge it daily. Sometimes you don't hedge it. So what happens like there's all this like P&L variance that happens
Mm.
because the way I think of it is like when you hedge, you are sampling your own vol. So like when people let's just say close to close vol. People look at close to close vol. Well, that's just like one vol. Like if I sampled it any other time of the day, I would get a different vol. Or if I sampled every 5 days, I would get a totally different vol. So in the act of delta hedging, I am sampling a vol that nobody else knows about, right? Because it's not published anywhere. Only I know about it. So what you want to do is sort of like, let me normalize my P&L to just say, what would have happened if I just hedge daily at the close? And I
Mm.
could just benchmark my performance to that. And like just benchmarking one trade that's not going to do much for you. But if you do that over time, you'll basically be able to back out like, hey, am I uh am I picking good longs and picking good shorts? And again, we come back to this normalization problem because, one of the things, I mean, okay, like you would do this in a hedge fund, but like let's say you thought that these vols were low. What you do need to do is sort of take the beta of vol sort of out of the marketplace, right? Because like if you buy a bunch of vol, if you net buy all this Vega and vol in the market just goes up because the market goes down, that's not going to help you know if you did a good job. So what you need to do there, so what you might do there is say like, if I bought these vols and I sold these other vols, so that like I construct like a vol neutral basket and benchmark to that, then you can be able to say something about like, am I doing a good job on picking my longs and shorts? So the more you kind of like go down that rabbit hole, the more you can learn more about what you're doing. And I feel like that kind of like shortens the feedback loop.
Yeah,
Um,
yeah. I think that's awesome. That's a great way to think about it. And it's a fun one too because there's a lot of different ways to try to at least get interim feedback, but it's something I find interesting, especially for retail traders that don't have that same context window and like trying to make sure that we're aware of path, but also getting enough feedback to develop some sort of confidence interval with this thing, which makes a lot of sense the way that you're thinking about that. A follow-on question is a lot of your work, like most prior institutional side options traders, centers around vol when it comes to options. What has led you to really kind of focus on different vol market effects? And do you focus on other market effects as well? Do you do any like momentum factor and stuff like that? Or is it pretty much centered on vol for you?
I would say it's been totally centered on vol for me. I have sat very close to sort of CTA style strategies that had a completely different set of signaling kind of going into those models. So I am aware, very like I'm very aware of like other ways of sort of like approaching the market, but um, it's not the thing that I was, dove into. I wasn't deep into it myself. So, some of the stuff that was kind of related to that was trying to see if, so like vol inspired delta signals. So like,
Mhm.
what can we see in the surface that might provide a delta signal? But I would not, you know, not paying my mortgage by anything I've learned from that world, right? Like that's it's like I hesitate to like talk on things that like I have not done to a level of depth that I think is adequate. So um I would it's like stuff I've explored, but I don't think it's uh I have very low confidence in that stuff. I think that that is a really interesting area by the though. I do think it's like a pretty cool area for research, where people should probably be thinking about things in terms of like, hey, maybe the vol market is telling me something that like maybe there's not necessarily an opportunity in the vol, but maybe it's telling me something about the delta. And even if it's telling me something that's asymmetrical, like it could just say, maybe when VRPs get really, really high, maybe instead of that being like, hey, I should be selling these, it's like, hey, I should be lightening the load on my delta overall. And like maybe the opposite, like a low VRP, there's no signal in that. That's what I mean by it could be asymmetrical where it's like on just like a sentiment indicator could like mean something at the bottom but not very useful at the top or something like that. I think that whole line of research could actually be super interesting, but I've pretty much only I mean, you can spend all your time just focused on vol and that will what I mean, you could like spend a career doing that. So you don't it's like you don't have to go out and venture into other stuff.
Which is completely fair. I actually noticed that, especially when I talk to people like you and Sinclair. It's another great example of that. It's like very, very, very vol heavy. And it's always fun because, like I was telling you in the beginning, I am like a retail street rat. So I play with everything. And whenever I start reading some of your guys' stuff about vol, you really do start to realize the rabbit hole that is. Because I also know you guys are distilling down an insane amount of information into bite-sized pieces that are convenient for us to read, right? So imagine all the source information that goes into that final product. And it's like, yeah, that could take a while. So when you think about vol trading, but for retail traders, what are some ways that you think are logical for that specific cohort to approach? And let's make the assumption that the account size they might be dealing with is $100,000 because it's scalable for everybody. You could divide by 10, whatever.
Hmm. Yeah, so I think that I think one of the for retail traders, let me separate um the use of options
Okay.
into vol trading versus using versus what directional trading. Whether the directional trading or is hedging or speculating. So vol trading is I would say that vol trading where I'll make a distinction between vol traders and regular investors.
Okay.
Like a regular investor wakes up in the morning and has an opinion about, I read a balance sheet and I think that, this stock is primed to go up 20%, whatever, over the next year, whatever it is. So like they come to the table with an opinion already about a stock based upon some research that they did. And that drives their trade thesis. The option trader has and what they do is that they assume that the vol market is fairly priced, right? So that's they say, oh, the underlying is mispriced, and if they're going to use options, they're like, I assume the options market is fairly priced, and I'm going to go do that. Then I'm going to go express my directional trade by buying calls, whatever. The option trader has the exact opposite way of seeing the world. The option trader wakes up in the morning with a view on vol, a view on vol that doesn't come from the stock, but just comes from looking at the vol markets and forming a differentiated opinion about the vol itself. Um, and then they assume the underlying is fair. And the whole act of delta hedging is one that says, I don't know anything. I'm just going to buy it and sell it according to the delta here. So, uh, so we have two completely different opposing views on on how we approach the market. So if you are, I think the vol trading thing is a lot harder for retail just because the cost structure of options is much harder. Like that, that bid ask spread in percentage terms is punitive. I mean, the top 50 names, it's like it's fine,
Sure.
but like once you're past the top 50 names, those bid ask spreads get fairly punitive. And uh, the other thing is uh, vol trading is by its nature just a high volume, low margin business. And a high volume, low margin business is one that sort of begs for scale, right? And you're just not like your prime broker's funding rates are just not competitive with an institutional funding rate, right? So like if you're running a bunch of long, short, and delta hedging this giant book, the funding that you're paying on your longs versus your shorts alone is just probably crowding out a lot of what you vol edge that you think you're getting. And remember, like, you're over time, it's like you could measure how much money I was making in like a couple cents per contract. That's the margins that you're playing with. And like if your cost structure, I mean, just think about the brokerage rate on an options contract. And remember, like somebody might say, well, my brokerage rate is a zero. Well, it's like, yeah, because you're being fed to somebody. So
Yeah.
that's why zero. So like
You're on
assume
the front end.
right. If you choose the brokerage tier that's more professional based where you're not being served up, then there is a discrete fee, and that fee is probably about twice what it is for institutional player. If you're paying 50 cents a contract, well, institutions are paying probably more like 25 cents a contract. Um, so if you're trading for a dollar of edge per contract, that's 25%. You're like already 25% behind just on the transaction fee of the actual contract, right? So the I think in general, vol trading is a scale business that sort of like requires like a pretty good cost structure. Um, so I think the best place for sort of a retail trader is if they come into it with there's some other idea that they've already showed up with that then the bar is much lower. Then it's like, hey, I am bullish on this thing and I'm going to use options. What's the best option to choose? Because a lot of what's the driver of the P&L is the sort of the thesis that they had on the other like from the research, and they are just making the best choice given the options landscape. But it's like one thing to be like, I'm gonna buy this option because I think it's 2 cents cheap, and I'm gonna sell this option because I think it's 1 cent rich and try to make money off of that. Versus, I think that I want to be bullish this stock. I've got these menu of choices to choose between the options, and I'm just gonna pick I'm gonna pick the best one for my expression. I think that that's a far easier bar. I'll liken it to another example I've given in a like institutional trading framework, which is that uh so a big cost in options trading is delta hedging. Like it is a cost. It is like you're reducing risk and you're paying some cost to do that. And the most of that cost shows up in slippage. So you can imagine what happens is like these trading firms spend a lot of time working on like delta models to like do better on that because for them, if they could cut their slippage from 5 basis points to 1 basis point scaled over everything that they do, it's like massive amount of money. So uh so what they might do there, so what their goal is I want to just trade less deltas. I want to trade less deltas. That is their goal. So if they can find like let's say so what they might do is like I'm going to come up with a mean reversion strategy and I'm going to come up with a momentum strategy and I'm going to come up with all these like delta related strategies that have nothing to do with options whatsoever. And when I accumulate deltas, I'm going to ask the system, is the delta that I accumulated that I was going to go hedge in the market, I was going to go face the street and hedge this delta, would it, could I just give it to the system and have it be absorbed into the momentum strategy? And the thing is if all those strategies summed up and they had no alpha, but they were break even, you've won because the benchmark was I just don't want to go trade against the street. But if I can
Mm,
stick all the risk in this system and then the risk just like the output of it has zero expectancy, but it has noise, and I'm fine with the noise. I have actually created money out of sort of nothing, right? Because I've saved myself the cost of trading. I've by absorbing this risk in this sort of other way. So
right.
I think that sometimes it's interesting to like benchmark to be like, a win condition here would be like I had a zero expectancy strategy that just didn't require me to hedge. So I think that that's kind of a little bit of like how I think about these things is like even when I think about like the software, I'm like the software we can help you make a better decision on like what option structure to choose, right? You can make a better choice, and if you make a couple better choices over the course of how many contracts you trade a year, it's material money.
Right.
But you didn't have to be a vol trader to do that. If you don't mind, I'll give you another example actually, because this one is like uh really useful, I think, for retail traders. Maybe one of the most useful things, I think, is just understanding that the options market has an implied futures curve in it, right? With like the cost of funding, right?
Mhm.
So this is all stocks have a synthetic are synthetically a future through the options. You can buy a call, sell a put, and that is a synthetic future. And the price of that synthetic future reflects the cost of funding until that term. I was looking the other day and I was looking on IBKR, and if you wanted to short USO, their fee for shorting USO is 6%. So you got to borrow the shares and you'll sell the shares. And normally, if there was no fee, you would collect SOFR minus 25 basis points, whatever, on the cash in your account from shorting USO. But here they're saying, no, we're going to charge you 6% a year to short these shares. So if I short 100,000 USO, it's gonna cost me $6,000 over the course of a year to be able to hold that position, or $500 a month. But if you went and you look at like the 1 year synthetic future in USO, you can actually collect 3%. Okay? Like you can sell the call, buy the put, have the same exact exposure, which is short USO. There's no vol risk in it. And instead of paying IBKR 6%, you get to collect 3% as if you had shorted the shares and collecting interest on the proceeds. That is like such an easy win for retail that like, hey, just trade the synthetic instead of shorting the shares. And so uh, I just think like when it comes to options have all these ways of like you can look at that market and be like, hey, there's just like a better way, or a more efficient way to express that bet. And if I had to like generalize what happened there, it's rather than you paying IBKR, the funding fee, you are inheriting the market maker's funding rate. That's why it's priced at 3%, is because some market maker is borrowing at 2.5%, and another one is lending at 2.5% and borrowing at 3.5%. So 3% is like the fair rate for that thing. So what happens is like you just go around the IBKR and you're like, I'm just gonna take the market maker's rate, and that's how you can do it by trading the options because that's going to be priced off of how they price it.
A question on that from a technical level, is there any element of that pricing that also has to do though with the fact that you would have to adjust that trade over the lifespan in order to maintain
You
that
don't.
delta position?
You don't. You don't. You just do nothing. You're fine. Like
Yeah,
like
because you were talking about the
you're not delta hedging it.
synthetic short.
Yeah. You're just gonna do is all you're gonna do is you're gonna sell the call and
Yep.
you're gonna buy the put. So the like you might have to post I mean you might have to post more margin. You are short a call.
Hmm.
But if the market goes down,
Right.
your account value also gets marked to market higher. So, you know, this is there's some path there's certainly some path annoyance in like from a margin point of view there. But on average, you shouldn't have to do anything.
Right.
Yeah.
Right. That's
So
fascinating.
yeah. So I don't know. There's like I don't know. Options are super fascinating because it's like there is like sort of easy wins there, and there's things that the market kind of tells you, that the options market tells you that you would never notice if you were only looking at the cash market.
Which is funny because I have two follow-on questions, but I want to be respectful of your time. Can I ask one of them and then see if you have time for the second?
Sure, absolutely.
Beautiful. It's literally on that exact topic. So it's the perfect segue. You read my mind. In terms of using the surface in order to help round out your understanding of a stock and just what the market is pricing, what are some of your favorite tips, tools, tricks in order to do that?
Yeah. So two things. Two things. One is simply the level of implied vol in general. One uh trader math thing that everybody that touches an option should be aware of is that if you take the implied vol and you divide it by 16, that will give you the daily, that'll handicap your daily, what the market expects a daily move in the name to be. That right off the bat is super useful because at the end of the day, like sizing any kind of position is downstream of like, well, how much variance does this thing have day to day? And the market tells me how much variance there could be in here day to day, or it's the best guess that we have, I should say, of how much this thing can move every day. And I can just take the implied vol, divide by 16. So that's like number one. It's like, am I trading something that moves 1% a day or am I trading something that moves 4% a day? So that's one thing we can take out of the options market. Another thing is earnings. So when you see a uh, if you're not in like a generally stressed like like if the VIX term structure if the VIX term structure is ascending, in other words, like a normal-ish market, and your stock's term structure is descending, well, something's up. So there's most likely an event coming up, whether it's I mean earnings being the most common, but it can be things um, like a conference where they're gonna reveal a product, right? So that's another thing. So the term structure has information inside it. Uh, the other thing that's not related to the term structure but has to do with the skew within a month is the value of the calls and put spreads. So or the skew you could say the skew. So if like in these meme stocks, what tends to happen is um, the as the stock goes up, the vol also goes up, and the call skew is the calls are richer in vol terms than the puts are. The puts will tend to decline relative to the calls or relative to the at the money. And this is the opposite behavior that we typically observe. And but that tells you something. It tells you that when this market goes up, that is destabilizing. That's how I think of it. This is a destabilizing move to the market. The market says, I don't know how high this thing can go. We tend to see that in commodities where commodities have inverted skews because the up moves are destabilizing. And it makes sense that they're destabilizing because, if you think about the price of gas, you have inelastic demand meets inelastic supply. So if we're gonna run out of gas, people still need to heat their homes. So they're gonna be bidding for it, like electricity. There's no version of the world where you're like, I'm just gonna ration electricity to zero. That doesn't happen. So the stress in those markets is to the upside. So the skew is to the upside. So when you look at a market and you look at the skew, it tells you what direction the stress is. And if you're trading GameStop 5 years ago, well, the stress was probably the downside. But now when it goes up, it inverts. And that makes sense because when GameStop goes back down, everybody breathes a sigh of relief and says, "Oh, the world is sane again." Right? It's stabilizing. For coals to go back down is will be a stabilizing move. So you would expect that the implied vol will fall when coals goes back down. Sanity has prevailed, is being sort of the sentiment there. So the skew tell and one way you can sort of see that is the value of the call spreads and put spreads. Because what happens is if put skew gets really, really cheap, that is the same thing as the put spreads becoming very expensive, which is a little counterintuitive, but it's because the implied vol of the downside falls relative to the strikes above it, and that will push the put spreads up. And that also makes sense because a put spread is just an over-under bet. It says, um, I buy a put spread, a $5 wide put spread for $2. I get paid 3 to 2 if the stock drops sort of below the strikes. Um, that's a pure bar bet. And so in that case, in the situation of like Kohl's or GameStop, nobody believes that when the stock makes this rally, that it's going to make this big rally and then stay up there. We don't know how high it's going to go, which just makes it like why it's like kind of diabolical to short it, right? But we also believe that it's going to expire. It will be lower in 1 year than it is right at this nosebleed price. We believe it's going to be lower. So if you look at, and so you might say, oh, I'm going to go buy a put spread because that's like a really clean way. I can just bet on it being lower without being shaken out of the trade. And then you will go and you will find that all the put spreads are very expensive. And you were looking and you find out, hey, I thought I was going to be getting like 3 to 1 odds on buying this thing when it goes back down. It turns out the market's only going to offer me even money odds. So, I only get paid 1 to 1 on this stock dropping 30%. Well, that sure doesn't feel like a great bet. I feel like I should be getting paid odds on something so extreme as a stock falling 30%. But that tells you that the market says, no, 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 no. The stock falling 30%, that's like our median expectation.
Right.
So between a term structure being taking the shape that looks very different from the VIX term structure, the skew, and the just the vol level itself, those are three things you can take directly out of the options marketplace that are otherwise hard to observe from just the stock itself.
Awesome. And a follow-on question, but moving from vol into the positions within the various terms and total chain. So talking like OI, volume over OI, stuff like that. Do you use that at all? Do you think that there's anything in those kinds of metrics?
So I where I one of the things that I would say this. I used to use it more, but I also used to use it with more with a lot more context. I used to use it more as a market maker because um because we were tracking flows, meaning like tracking
Right.
literal counterpart. Like we don't know who the counterparties are, but we're like literally trying our best to counter to track those flows. Like pretty much the way like people on Twitter do the JP Morgan roll. Like
Yeah,
they
yeah,
know what the strike is, like that kind of thing. So that is a little bit more narrow than just like broadly looking like at all the strikes. Like it has to be something about the strike that alerts me to it that like I know that there was some chunky trade that happened in it and that the OI is a bit concentrated on the strike. So we might, I would pay more attention there. So it's like I don't never really like broadly cared about like the open interest in general. It's just more like where was their concentration? And a lot of the concentration being because you absolutely, as you get closer to expiration, the gamma on on those strikes gets really, really large, and you can either get, you get the tractor beam, or you get the situation where you can have a runaway situation if you kind of like blow through the strike. So like both of those effects, I think hold water. It's just that whether like if you're looking 6 months out at that open interest, I think it's a lot harder to say if any of that matters. It's because the dollar gamma is not high enough for it to necessarily matter. Um, but as you get closer, and expiration trading is basically flipping coins. It's like super like nobody knows anything, and like you get there, and so there's just a lot. It's just naturally just a lot more risk. And this is like the thing to understand about expiration trading. And zero DTE trading. It's just signing up for like a bunch of risk. That's like pretty hard to actually, I think, to like sort of model. But that's what I would care about those things. I know that that's kind of really it's really popular now to talk about that, like Vanna and charm flows and all that kind of stuff. But so I know that that's got a lot of people's attention these days. I mean, I always wonder. I mean, that stuff like seems kind of neat to me, but I also I guess I have more questions about that stuff than sort of like any kind of answers. Like my questions revolve around things like if there's a bunch of index risk in one part of the surface, like in the SPX, these firms that take the other side of that, like a lot of them are running dispersion books. So
Hmm.
if they sell a bunch of S&P calls, uh, well, they're also buying single stock calls against it. So if you just focus on the outstanding gamma in the market, as it feels to me like just on the S&P side, it's like you kind of left out half the ledger because the
Hmm.
dealers are also long all this single stock gamma up there. So and how it kind of feels, it just feels like a way more complicated thing than I
Right.
think that sometimes it can be presented, because there is another side to that ledger, that is uh maybe somebody will start to like kind of develop that out. That'd be kind of cool. But so that's one of the questions I have about that. And the other thing I have about sometimes I think about that is like, it's a bit of it's an overlapping signal with the skew itself, right? Because like if there's if the customers sold a bunch of upside calls, that's also like, yes, it's going to be in the open interest, and yes, the stock is probably going to like not move as much when you get up there because of the gamma, but like that was also sort of baked into the fact that the skew is going to be really cheap there. So it's like the market makers didn't just take that on and just like unaware of this, right? Like it affects the delta that they hedge on, like which, they'll lean their delta like sort of into the strike as we get up there. So um I just think it's a bit more complicated, or there are some people that I know that are like kind of tracking this stuff that I think have like a really solid market making background. So they would have a better I think that they'd probably do a pretty good job of like at least thinking about what those dynamics look like. Because I think if you're not familiar with how a delta neutral book is run, you could really kind of like go crazy like with a tinfoil hat on what this means. Where I can assure you, you don't know something that the market makers don't know about that, and they're managing to it already.
It's funny you say that because I'm actually in the process of running a like 3 year study on price behavior and vol behavior around both Charm, Vanna, Dex, and Get. Well, I guess all four,
Hmm.
Dex and Gex. But I'm just focusing on the effect side, less on the cause side, because I am a Neanderthal and don't belong in the effect side of the equation. And it's funny because I think your intuition, at least so far, aligns primarily with what I've seen. And right now, I'm in the process of trying to feature match a little bit to see if I can find specific things that might be more predictive. But it's kind of a crapshoot. So I think your
I think it's a
summation.
hard problem. I mean, honestly, like I think part of it it's just like a really, I think it's a really hard problem, and I think that because I think modeling the underlying dynamic of like how people might be managing to that because you are playing, right? It is this adaptive thing. It's like, yes, everybody sees like where that open interest is. Everybody knows where those like sort of like where the bodies are. But the market makers' delta leans and their positioning is aware of that and incorporating that in their deltas. Like they don't like, for example, if you the output of those models is using the like a Black-Scholes delta to tell you how much there is to buy or sell. But the market makers are not. They're not going to be using or they might be using a Black-Scholes delta, but then they're running a lean. Like I'll tell you right now that like all the like very rarely did I necessarily believe my Black-Scholes delta on my books. So if you're trying to like naively predict what my underlying share delta is by looking at the Black-Scholes delta, I think that you're just sort of like not appreciating the fact that like you know something and I know that you know something, like that whole, Princess Bride thing.
Mhm.
So that's but anyway, I do think it's like largely interesting, but yeah, it's not a focus of mine.
Yeah, totally, totally fair. You have two rapid fire questions because honestly, we got through maybe like 20% of what's on. I literally could just fucking monopolize your time, and I don't want to do that. I know that you got shit to do. Um, but two quicker questions. The first one is why do you think optionality is like often misunderstood by people? I've heard you mention that in different ways and give some different examples. But I find the topic really interesting because I actually don't think most retail traders really even acknowledge that concept.
Hmm. That's a good question. What it's funny, I feel like when I've written about that, it's like more in the context, sometimes like more in the context of decision making,
Yeah, exactly.
and sort of like opportunity costs and that kind of thing, rather than sort of like the hard optionality that we're talking about when it comes to, option contracts.
Mm-hmm.
Uh, but I think it's kind of, there's like a area where this stuff is kind of interesting where like, you know, so if you think about like, and this is like me like showing some commodity market stripes, but like the if you think about like the way like crude oil is refined into products like gasoline and heating oil and diesel, jet fuel. So like a refiner is actually an option in itself, right? Because if the refining spread is really really wide, they're gonna take as much crude as they can and run it, and and if the refining spreads like break or like they go really cheap, like they're just gonna run less. They're gonna run less crude through the system, which will eventually lead to lower supply of the finished product. So they have sort of like optionality in there in terms of like, so a refinery like literally is an option, or a storage operator in the oil market that can buy cash oil and sell the 1 month future forward, right? And sort of like harvest that contango, the 1 month contango. So like if the 1 month contango is 50 cents, like they can make $6 a year sort of like buying cash oil and then selling it forward. And if the spread blows out even further, like it's $1, they get to make even more money with the storage asset. And if we go backwardated, the storage asset doesn't they just won't use it, right? Because you can't do cash and carry trades anymore, so the storage asset sits dormant. So it looks an awful lot like a put because it makes money when the oil market drops and the contango widens, and when oil rips higher and because of some Middle East tension, the storage is not worth very much. You can't do the cash and carry trade. So like there's optionality sort of like embedded in these things. And then you have to like, one thing that's kind of interesting there is like for a long time, the options on these spreads, the refining margins, the future spreads, they were really cheap. And the reason the options were cheap is because those people that own those assets were just natural sellers of them.
Hmm.
So it comes back. So like in this example, you're coming back to like understanding why somebody would trade this weird thing in the first place. And it's like almost like those things were like listed to be sold because they were the natural thing that those physical players needed to do was to get rid of they had this optionality that they wanted to offload or they wanted to monetize through selling those. And so if you recognize that and you are a trader in that space, you say, "Oh, there's like this optionality out there that's like being sold kind of cheap because it's a one-way market. Like there's no natural buyer really for this option, but there are these natural sellers of these options because that's what their business is. So I think like looking like optionality is one of these things that um, you kind of you kind of look for it because it creates. When I think about optionality, I really just think of a chart. I just see the hockey stick diagram. That's all I see in my head is like, oh, there's an option there. Like, there's a kink in the curve, right? So it's kind of like looking for situations where there's kind of a kink in the curve. And kinks and curves are interesting because it's like you can have if they're not apparent to everybody, like that can be a source of opportunity. Especially if you're like looking at a new situation, you're like, oh, there's like I noticed that like this dynamic would change if we hit this price level. It's kind of like even natural gas, by the way, today, natural gas puts can sometimes be cheap because what ends up happening is, when the price of gas falls long enough, you'll switch from using coal to gas. Like that,
Hmm.
it's like it's literally called coal switching. So people will run less coal and they'll run gas if the price of gas gets cheap enough, which means that there's support for gas when it goes lower, which tells you something about what the put skew should look like relative to the calls. This put
Right.
skew should be cheaper because it's pretty hard for gas to just completely crash because there is all this extra demand that's going to come for it once it hits a low enough price level. And this is a very strange idea to a stock investor potentially because there are these weird like price sensitive inflection points that can happen based upon like the idiosyncrasies of the underlying market. So, maybe the equivalent in there would be like a stock that has a deal in it or possible M&A or, for example, or I screwed up a trade. I'm kind of like rambling, but like I screwed up a trade like back in like 2008. If you remember, like Microsoft like bid somewhere around $30 for Yahoo. And then we started having like this big, we had started having the crisis. It was like trying to before the crisis. Like Microsoft tried to buy Yahoo, and the deal didn't happen. And the price of Yahoo stock, I remember when it hit $20, I bought it, and I think it bottomed out somewhere around like half that, like 10 or 11, like during the financial crisis. But I bought it because in my mind there was a hockey stick diagram somewhere below. I didn't know where the strike was, but I'm thinking to myself, well, Microsoft not freaking 3 months ago wanted to pay 30 for you. So I think I'll buy it for 20 because like it's like it feels like there's some bid like hanging out somewhere. Like I felt like I had a free roll on the stock, you know.
Uh-huh.
I just kind of got, maybe I got unlucky because it was a GFC. I don't know. But like, if there was no GFC, I wonder if that reasoning would have been right, is actually what I'm saying. But obviously there was a GFC.
Right.
So, maybe if I had like traded that, yeah, I don't know. Anyway, the point is like I thought there was an option in there in a sense, and that this like option to lean on Microsoft's interest in the stock, it turned out that it didn't work out. But anyway, it's like you're kind of looking for these things where like the situation's not as continuous as you think it is.
Well, it's a really funny example too, because Twitter's a great recent example of this buyout news, right? Where Musk casually throws out, I'm going to buy it. And then, you can literally see Twitter jump to like a point or two off of where it was. Then Musk is like, damn, there's a lot of bots. I don't want this. And then it plummets again. So yeah, I feel like the example there is actually really pertinent, but there's a really recent one where you can see multiple shifts in
Yep.
that same path, which is pretty entertaining. And then your example about the refinery also struck home because it reminded me of like the Thales olive oil press, from 350 BC. There's a component from one of Ewan's books where he talks about like that being the first option, where he bought the rights to this press. So you guys have a pretty significant overlap in terms of the example for optionality, which is kind of cool. All right, last question.
Yeah.
When you think about volatility and people's perception slash understanding of volatility, what do you think is like a piece of information that most people should integrate into the way that they think about vol?
Okay. Uh, that the idea that if IV is high, that it's or the IV is high, that it's a sale, and that when it's low, it's a buy. That's my answer to that. The and the reason for this is implied vol does not vary as widely as the realized vol does. So what happens is the low extreme, you get the situation that we're in right now, where S&P is realizing six, but implied vol markets are forward looking and expecting mean reversion. So the S&P vol will only get to let's say I don't know, actually don't know where it is now, but like the 1 month, for example. But let's say the 1 month is you have the 1 month up.
I can grab it. So for SPY, I see 28 days is at 14.76.
Okay. And then I see SPY vol as, realizing over the last month or so, or over uh
So the
yeah. Oh,
last
the weekly realized in SPY is, oh my God, it is six. The monthly is 7.1 on
Yeah.
here. Okay. All right. So you look at that and you say in the 1 month implied vol is whatever, what do you say, 14?
1 month is 14 and three quarters.
Okay. Almost 15.
Yep.
So so that is what's tricky there is like the vol is quote unquote low based on like a 1 year look back, but it's expensive to own it. So what's happening is you are getting if you buy it, you feel like you're getting directional edge, but you're going to lose on the carry. And if you
Mm-hmm.
sell it, directional edge meaning that it can go up a lot more than it can go down, right? Um, but if you sell it, you're going to get carry, but you can be it just takes 1 day to be really wrong on this vol, right? So the so in other words, it's what I call like a no easy trade situation. Like what I would do is like that's why I say like you need to look at the blob and see like what stuff is relatively expensive and relatively cheap, like kind of relative to each other, rather than just looking at that and being like, I'm going to just trade this vol sort of outright. It's a pretty hard trade. Like the IV is low, but the realized is a lot lower. Likewise, the same thing happens on the upside. People say, oh, when the vol gets to 60, I'm going to sell it. Well, you know what happens when it gets to 60? It's realizing 90
Mm-hmm.
because it doesn't get higher. Maybe it doesn't go higher than 60 because the market is forward looking and it expects this to relax. So if you sell it at 60 and it takes longer for it to relax than for that, like every day that passes, you're sort of like losing to being short that vol. This is exactly what happens with the VIX futures. Like everyone says, oh, when the VIX goes up, I'm going to sell it. The problem is you can't sell the VIX because it's a cash index. You can sell the future, but the future trades at a discount to the VIX because it's forward looking. So it was actually interesting because like one of the better trades I had this year was buying the VIX futures in April at their high because the discount to spot VIX was enormous. And so every day that passes, your VIX future and every day that passes and spot VIX is not relaxing, your VIX future is rolling up.
Right.
So you're getting positive theta on your future. And the reason it's just like one of the reasons like it's not going down is because everybody sells it because they have the same thinking, but they're not taking into account how much negative carry you actually have in the trade. So it could work out, but if it doesn't relax fast enough, you are like losing a little bit every day. You need it to relax pretty quick for you to win to that trade. So that's probably the number one thing that people don't understand about vol is that low does not mean cheap and high does not mean expensive, because they tend to have the opposite carry characteristic. When the vol is high, if you sell it, you'll have negative carry. And when the vol is low, if you buy it, you're going to have negative carry. That's the thing that people are sort of missing. And I like to say, like in the real world, we already understand this when it comes to stock prices. When stocks are probably, their PEs get really, really, like when the stock like collapses, it's like the PE can stay kind of elevated because the market, there's some mean reversion aspect to it, or like, you know, everybody wants to buy it when it falls. So they're probably buying it when it falls is actually kind of when it's expensive.
Mm,
Like on a fundamental basis. I mean, obviously the whole world just does nothing but go up. So like in the US, so like saying that makes me just sound like, but like on a relative basis, it's probably true that these companies that like fall and their PEs
right.
fall are just turned into value. We have a word for them, like value traps. So the fact that a value trap exists should be a hint that A, the markets are actually kind of smart to some degree, and it's not as easy as just picking the thing that has the low PE. Likewise, it's not as easy as picking the thing that is low vol. So I think the implied it's like understanding, and this is why we circle all the way back to a trader is a trader. Doesn't matter what the market is. You should have some expectation of like if people see a low number, they are probably buying it. So the contrarian thing is to probably to sell the low number, but you do have to understand like why you might be trying to, like, you kind of have to understand the shape of that trade. So like maybe the trade there is like right now is to be like buying S&P calendars. Somebody says,
Mm,
but you're paying even more for the back month than you are for the 1 month. But have you really thought through what the cost of that calendar is? Like, yes, you're going to be losing on both, but why would you be making more on the front and than what you lose on the back, even if you assume that the back rolls down? Like, have you walked through the arithmetic on that? If you do, you might find a contrarian trade that actually works. So, um, you kind of have to start with like people see low number, probably think buy. How could they be wrong? Likewise, people see meme stock ripping higher, probably think that's stupid. I should sell, or they used to. They used to. Now,
enough people have learned.
yeah, the internal meta of the market has probably changed. They see the thing go up and now they buy it. But it used to be the case, like, oh, so some hedge fund wise guy is like, oh, look, the thing's up a lot. I should sell it. Or like the guy that blew out in natural gas, look,
Yeah,
the price is
yeah,
up. I'm going to sell it. It's like, no, actually, weirdly, buying it might be the contrarian thing to do there. So,
right.
but you still have to like understand the parameters of the trade. So anyway, yeah, don't just sell high vols and just don't buy low vols without actually thinking through what the market knows when it sets those vols.
I absolutely love that. That's such a good, especially because there's a lot of different takes that people have on it. And I think, unfortunately, in an attempt to simplify things, you can kind of oversimplify stuff. And then that's one of the artifacts I think that often comes out of that. So I love that. It's, as you know, I deeply, deeply appreciate your work and what you do for the community. It's super cool. I told you a little bit about this before, and I know it's always uncomfortable, but I do think it's important for you to hear it. Just that pretty much everybody is super thankful for what you do. You provide a lot of information and a lot of thoughtware, right? You just get people thinking, which is really cool. Thank you so much for doing that, and thanks for hanging out.
I appreciate that. It's a pleasure to do it, and I'm really happy that you had me on today.
Yeah, beautiful. And then for people that are interested in checking out your app and stuff, they can find you. I can throw a link to all that in the notes below. Is there anywhere else that you want people to be able to reach out or take a look at your stuff?
The two places, the app is moontower.ai, and the weekly writing, I write 3 times a week. That's at moontower.substack. I write about investing, and I write about life.
You do. And for those that do check out the Substack every once in a while, you are going to have to sit down and take a break. So you're going to have to read something 32 times to understand it, but sooner or later you can grasp it. I promise. But Kris, thanks so much for the time, man. Definitely looking forward to keeping in touch, having you back on in the future, and enjoy your weekend, man.
Thank you. You too, man.